Hello, I'm Michael Cochran with BentOak Capital, here to provide a brief market update for May 2024. Please make sure to watch till the end for an important disclosure statement. Following a robust performance in the first quarter, stock markets experienced a decline in April, with the S&P 500 falling approximately 4% during the month. Despite this setback, there is optimism that May will bring better results, notwithstanding the popular saying in the stock market, "Sell in May and go away." This adage holds some validity, as historical data suggests the S&P 500 tends to perform better during the 6-month period from November to April compared to the period from May to October. However, it's important to acknowledge that historically the index has still managed to yield an average gain of 1.8% during the May to October timeframe, which is hardly worth avoiding. Despite the solid gains witnessed in the stock market this year, the consistent expansion of the U.S. economy and the concurrent rise in corporate profits suggest the potential for further growth in the future. Although the recent GDP data initially appeared lackluster, the U.S. economy is expanding by just 1.6% in the first quarter. Underlying indicators such as inventories and trade masked robust consumer and business demand. Consumer spending demonstrated a commendable increase of 2.5%, while capital investment surged by 2.9%. Despite the ongoing speculation among economists about the possibility of an impending slowdown, the current data indicates that we have not yet reached that point. While there may be a deceleration in economic growth later this year, it is not manifested thus far. So what caused stocks to dip? Beyond some digestion of strong gains through March, stubborn inflation and higher interest rates were the main culprits. As the downtrend in inflation has stalled recently, expectations for the Federal Reserve's rate-cutting campaign have been pushed out. With the preferred inflation measure stuck near 3%, markets now expect 1 or possibly 2 rate cuts this year, down from near 6 at the start of the year. Expect inflation to ease later this year as demand likely slows, but patience will be required. If you're concerned about a bigger slide, the numbers during corporate earnings season, now more than half complete, may be reassuring. A solid 80% of S&P 500 companies have beaten earnings estimates so far this quarter, with more than 8% average upside relative to estimates. Results from the big technology companies have mostly exceeded high expectations, and perhaps the most important earnings measure stick, estimates have moved higher and provide evidence of upbeat guidance from corporate managements. With the economy growing steadily and corporate profits rising, the near-term outlook for stocks still looks supportive. As always, there will be rainy days. Sticky inflation remains a thorn in the market side, and geopolitics are a potential stumbling block. Despite this, we should look for more positive trends than negative ones in May and potentially beyond. As we conclude this month's video, we encourage you to explore the resources available on our website, featuring a collection of insightful new blogs. Also, stay tuned for valuable updates on our social media channels. We continue our commitment to providing personalized service, and if you have any questions, please feel free to reach out to us.